Equities are hovering near record highs while oil holds around triple digits, and the Federal Reserve signals higher for longer. It is a market where AI-driven earnings are powering benchmarks higher even as energy shocks and sticky inflation complicate the macro picture. Welcome to vTalkInsight, Equity Pulse Daily for May 11th, 2026. Let us unpack how the latest data, sector moves, and company stories fit together for global equity markets. The latest U.S. labor report delivered a modest upside surprise without flashing outright overheating. Non-farm payrolls rose by around 115,000 in April versus expectations closer to 65,000, and unemployment held roughly stable in the low 4% range. That suggests the jobs engine is still turning over, with some signs of stabilization after a patchy run of monthly prints. At the same time, wage growth has cooled to the mid-3% area, pointing to less immediate pressure from pay-on inflation. Under the headline strength, the details are more nuanced. Labor force participation slipped to just under 62%, and broader underemployment has climbed to its highest level since December, indicating more slack than the headline unemployment rate implies. Commentary describes today's backdrop as one of low hiring and low firing. That combination looks like a fragile stability rather than a powerful reacceleration, and it is why some base cases still expect joblessness to drift above 4.5% into the summer. For the Fed, the bigger headache remains inflation rather than growth. Services prices, especially in so-called super core categories, are sticking above pre-pandemic norms, and recent data show price pressures broadening again after earlier progress. Energy and agricultural inputs are adding to that strain. High fuel and fertilizer costs are squeezing U.S. farmers, while elevated gasoline prices around $4.50 per gallon are feeding through to food, transport, and logistics costs. Against that backdrop, Fed officials are leaning toward a prolonged pause. Dissension on the committee and still firm data mean near-term rate cuts look unlikely, and some policymakers have even floated the risk of higher rates if the Strait of Hormuz disruption drags on and keeps energy elevated. Government bond yields reflect that tension. 10-year yields near the mid-4% area are seen by some as a danger zone for risk assets, especially if they rise further, and 2-year yields remain above policy rates. Credit markets are still pricing resilience with investment-grade spreads near multi-year tights and all-in yields around 5 to 6%. But the $1.8 trillion private credit complex is facing its sharpest confidence shock yet, with redemptions, downgrades, and a growing focus on refinancing risk. Oil remains the macro swing factor. Brent is oscillating around $100 a barrel as markets juggle persistent supply risk from the Strait of Hormuz with signs of shorter-term oversupply and healthy inventories, including in China. The base case being priced is a drawn-out, low-intensity conflict that keeps shipping constrained but stops short of full-scale escalation. Intelligence assessments that Iran can withstand a naval blockade for several months underscore why traders expect the disruption to persist. For corporates, those energy inputs are already biting. Moody's points to pressure on sectors such as airlines, building materials, and chemicals, while energy producers and some defense names benefit from the same backdrop. British Airways owner IAG has issued what looks close to a profit warning, cutting guidance for earnings and free cash flow as jet fuel and Middle East conflict push costs higher. Its stock has dropped, and the message is that capex and profit expectations across global airlines may need to be reset lower if oil stays near current levels. On the household side, the picture is equally split. The University of Michigan Sentiment Index has slumped to a record low in the high 40s, with respondents citing gasoline prices and cost of living as acute pressures. Companies such as Kraft Heinz and McDonald's are seeing softer cash flows and weakening confidence among lower-income customers, even as overall spending holds up better for middle and higher earners. Fiscal transfers and earlier tax cuts are cushioning the blow for those groups, but commentary warns that markets may be underestimating the lagged hit from sustained high fuel and utility bills. Putting this together, the risk set leans toward a mild stagflation narrative rather than a clean soft landing. Growth is being supported by a still functioning labor market and industrial hiring, yet headline inflation is kept sticky by energy and services. If oil inventories are drawn down while the strait remains constrained, a more severe price spike is possible, which would challenge both corporate margins and consumer resilience. That is why later this year, many are focused on the dangerous mix of higher yields and slower growth as a key vulnerability for equities. At the index level, equity markets look remarkably calm. The S&P 500 has just logged a sixth straight weekly gain and is hovering near all-time highs, while the Nasdaq is up roughly 2 to 3% on renewed enthusiasm for technology and semiconductors. Volatility remains contained, with the VIX recently drifting in the mid to high teens. Daily sector rotations, however, are sharp and under-the-surface dispersion is high. Gains are increasingly concentrated. A handful of large U.S. technology names account for a disproportionate share of S&P performance since April, and the top 5 constituents now drive much of the benchmark's direction. Semiconductor stocks have surged around 150% over the past year, approaching extremes last seen in the dot-com era. Nvidia, Qualcomm, and Micron have led recent rallies in the sector indices, fueling talk that any eventual correction could be abrupt rather than orderly. At the same time, there are signs of broadening beyond the megacaps. Commentary highlights accelerating earnings in mid and small caps tied into the AI supply chain, and notes that AI exposure now spans semis, memory, industrials, materials, and financials rather than just a few platform companies. Global AI capex is projected in the hundreds of billions of dollars this year and could approach $1 trillion next year, supported by roughly $2 trillion in order backlogs across key sectors. That investment wave is becoming a macro growth engine in its own right, sometimes overshadowing traditional data points like payrolls in driving equity sentiment. Regional performance reflects these cross-currents. Japanese equities have rallied about 25% off their lows, helped by leverage to the semiconductor cycle, while Europe is struggling under energy, travel, and financial sector headwinds, and is currently trading with a more risk-off tone. Valuation gaps between U.S. and international markets are now described as extreme, and upcoming mega IPOs such as potential listings of SpaceX or OpenAI could further concentrate benchmark performance. Many see long-duration growth stocks as especially sensitive if 10-year Treasury yields push well beyond 4.5%, which would pressure the discount rates underpinning today's valuations. Company-level news across the AI ecosystem shows both the strength of the theme and its vulnerabilities. Nvidia continues to act as the sector's bellwether, committing billions of dollars to equity stakes and long-term contracts with infrastructure partners, including a new $2.1 billion data center development with IREN. Yet questions are growing about how much of the apparent demand is organically driven versus supported by Nvidia's own balance sheet. CoreWeave's revenue miss, weaker guidance, and decision to step up capex, along with a notable share price drop, crystallize concerns that some AI infrastructure players may be stretching to match lofty expectations. Other chip and hardware names highlight execution and geopolitical risk. TSMC reported April sales up about 17.5% year-on-year, but still shy of what the market wanted for the quarter, implying it needs a strong May and June to hit upgraded guidance. Supermicro has come under pressure after U.S. prosecutors' alleged involvement in schemes to divert Nvidia AI chips into China via intermediaries, thrusting export control enforcement into the equity narrative. At the same time, Chinese AI firms are reportedly making rapid progress with cheaper open-source models that do not rely on the very highest-end U.S. chips, hinting at a more competitive global landscape. Within software and internet, AI is catalyzing both winners and losers. Cloudflare is cutting around 20% of its workforce and pivoting toward an AI-first strategy after disappointing guidance and a sharp share price drop, while Upwork's weaker outlook and job cuts point to structural pressure as automation reshapes freelance work. In contrast, Block has posted stronger than expected earnings, crediting AI-driven efficiencies and headcount reduction for margin gains, and has raised its full-year outlook. DraftKings is another bright spot, delivering high teens to low 20s revenue growth, slashing customer acquisition costs by roughly 90% with its new super app and achieving back-to-back quarters of positive net income. Financials and more defensive sectors add further texture. Commerzbank has lifted profit targets, plans significant job cuts, and is emphasizing AI adoption and its international network as it pushes back against a potential hostile bid from UniCredit, though markets remain skeptical about the ambition of its return targets. Waste management groups such as Republic Services continue to demonstrate recession resilience, maintaining high business floors and expanding margins even when industrial activity softens, and are beginning to deploy AI for route optimization and partial truck automation. On the other side of the risk spectrum, the private credit market is enduring its most serious confidence test so far, and Lime's IPO filing, which flags substantial doubt about its ability to continue as a going concern without fresh capital, underlines how tighter financing conditions can quickly turn growth stories into solvency debates. Stepping back, the equity picture is defined by tension between a still functional, if uneven, macro backdrop and a powerful but increasingly selective AI-driven earnings cycle. Jobs and growth data are good enough to keep the Fed on hold, yet not strong enough to fully offset the drag from high energy costs, fragile consumer confidence, and sticky services inflation. Index levels look calm, but leadership is narrow, semiconductors are stretched, and sector dispersion is wide as energy, AI-exposed names, and a few quality defensives carry the load while travel, airlines, and some leveraged growth stories struggle. From here, the key signposts are clear. Watch how long oil stays around triple digits, whether unemployment and underemployment edge higher into the summer, and whether AI capex continues to translate into real cash flow rather than just bigger balance sheets. The way those forces resolve will shape whether today's AI-led rally extends, broadens, or gives way to a more volatile phase. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.